Hi everyone, welcome again to another financial analysis video with myself, Moeed Amin, and my colleague, Ted Wayman. Yeah, we're going to be helping you become more financially literate, understand and read financial statements so that you can have smarter investments and have smarter discussions if you're looking to sell to certain businesses. Today, we're going to be looking at THG, or the Hut Group. It's a British business that is headquartered in Manchester Airport, and it's an e-commerce company. And essentially, they have about 100 international websites. What they do is they specialize in helping brands go direct to the consumers, right? So if you think about your brands, like in the luxury space, in the nutrition space, lifestyle, beauty, those are the kinds of areas that they're involved with. And they kind of involve with brands like MyProtein, Coggles, and Grow Gorgeous, just to give you some example. Now, this company is interesting because, and we're going to come on to this later on, so stick around, its share price has taken a bit of a nosedive, so much so that BlackRock sold about 50% of the shares that it currently had in the company back in November. So we're going to go on to that in a bit of detail. And with the financial analysis we're about to give you, you'll get some perspective on there. Before we get to that, don't forget to like, share, subscribe, particularly share, because we're here to help people become more financially literate. And if you feel there are people in your community that would value this kind of information, then do share with them. And one other note is a lot of our videos, maybe about 97% of them, are companies that we analyze based upon requests from you, the viewers. So if you have a company that you're interested in and you would like us to analyze them for you, do so. Just like this gentleman, Toby here, who requested this video. This is for you, Toby. So Ted, let's take it away. Let's share what we found out about the finances on this company.
Thank you very much, Moeed. Good to see you. Yep. So we're going to be looking at their financial report and accounts. You and I are talking. It is now the beginning of December 2021, and we're beginning looking at the annual reports, which is the year ended 2020. So yes, they are out of date. This is backward-looking analysis. We are not doing forward-looking analysis. So if you would like to comment on how out of date the analysis is, you are more than welcome, but please be polite in your comments. Also, if you've got any other comments, anything else you want to share about, any insight, any knowledge, I have to admit, I know absolutely nothing about their products. In fact, I don't think I've ever visited the Hut Group website, any of their products. So I'm coming at this very much from a financial analysis perspective rather than from any knowledge, inside knowledge of the business. So here is the Hut Group. This is their annual report and accounts. It's 2020. It's on their website. We will have a quick look at their half-yearly statement as well. But I kind of like annual reports. I like to have an auditor's signature next to the numbers. And what you'll notice here, first of all, is that not only is it very long, there's 157 pages, Moeed, but boy, do they love their pictures. I mean, this is like, this is really nice, pretty, jazzy, funky kind of, I mean, this is like an artwork in itself. Somebody's really gone to town and put lots of very pretty pictures, and it could almost be said to be a marketing a brochure in itself. So we're now scrolling down through all the kind of the corporate governance and the risk management and the environmental sustainability and who the directors are and how wonderful they are and blah 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 blah. There's our CEO, and quite frankly, kind of slightly lose the will to live after a while. But no, we'll get there, and we're really interested in, I guess we are interested in how much the directors earn, but we're really interested in the actual financial numbers, which finally pop up right down the bottom here on about, what are we on page now? 123 of 157. Good to see that Ernst & Young, solid bunch of accountants there, have signed off on these accounts. So here we go. Let's just scroll in and have a look at their consolidated income statement. So you can see that now in your, hopefully in your screen. So Few things to note. First of all, I quite like it when companies do this. So you'll notice that these guys, they've got a column that says before adjusted items, and then they've got adjustments, and then they got the total. Okay, we're just going to ignore these columns, quite frankly. I mean, I really, anything which is an adjusted item, you'll notice that adjusted items happen on a pretty regular basis. People often talk about sort of non-recurring items. It's surprising how many times non-recurring items actually reoccur. So we're really going to be focusing on these two numbers. You've got 2019, it's restated. There was some error in their original accounting, doesn't really build a lot of confidence for you. And then we got 2020. So we're going to focus on these two numbers. So let's start off with our top line analysis. What do we see? Well, first of all, great. We got a nice big increase in sales. Look at that. That's jumped up by about a 42% increase in sales. Gross profit is holding steady. The gross margin, that's the gross profit expressed as a percentage of sales, is staying steady at 44%, which basically means every time you pay a pound to the Hut Group for whatever product you're buying from them, then it costs them 56p to make or source that product, and they get to keep the other 44p. Sounds pretty good, pretty profitable. Well, yes, it is, until, of course, you get into this line here. Now, these distribution costs, don't forget, this is an e-commerce business, so effectively what they're saying is we don't have to pay rent. Great. Well, you don't have to pay rent for your high street stores. But what you do have to do is you have to send stuff out in the post, and that's expensive. So 350 million pounds. Notice we're in thousands of pounds. You notice the denomination at the top. So 350 million quid sending the stuff out, and probably lots of returns coming back and all that kind of stuff that it goes on. And then another 845 million pounds on the administrative costs. Sounds quite high to me, 850 million pounds. I'm struggling to work out what they can be spending 850 million pounds on for their admin. You know, you've got a finance team and an HR team, a bit of sales and marketing, and some techie engineers. But anyway, that's what they're doing. They are spending it. They may sort of say, oh, well, you know what, there's a sort of this big one-off hit that's never going to happen again. Well, something happened last time, but you'll notice that there is a big, maybe they want you to compare the kind of the before adjusted items here. So what they're saying is that on an operating basis, before the adjusted items, we're making a profit, but what we're reading in is that they're making a shocking great loss of 481 million pounds. No note here, so there's no kind of nothing's going to give you a little bit of information, although they do give you this note 4. Maybe we're going to have a look at note 4 and just see, if you're going to give us a note 4, we might as well make the effort to go and have a look and see what it is telling us about their business. Well, here we are, Moeed. We're on, you can see up the top here on this page, you've got note 3 up the top, hedge accounting. There's note 4 and note 5. Let's scroll into note 4, and note 4 talks about the error, so a share-based payment, an error in 2019, and they've made a correction as a result of that error. So really sort of no additional information about those large administrative costs, which we were hoping to find out. So perhaps they've hidden it somewhere else in the accounts. Anyway, we will leave that with them and return to our profit and loss account. So we're no longer not much wiser as a result of that visit to note 4, but here we are, we're back. So 841 million pound loss. They got some financing costs. Now, interesting enough, if you look at the financing costs, we can see the financing cost 53 million pounds, up from the previous year 33 million pounds. So that suggests that they've taken on more debt. Okay, not necessarily, but it suggests that they've taken on more debt. So we'll see if we can find that. A little bit of a tax refund. Anyway, bottom line is they are booking a £500 million loss, a little bit up from 2019 when they booked a £44 million loss. Is that COVID related? Possibly, I don't know. Theory is that if we're all stuck at home and nothing else to do, then we're online and shopping to make ourselves feel better. So you'd expect the Hut Group to do very well out of COVID, and you can see the sales have gone up. So I'm not sure it is COVID related. You know, they're going to argue, look, it's this number here. But even if you strip that out down to 0 and you take out this number here, you're still going to be at break even. So, you know, even without those numbers coming through, even without the adjusted items, they're still making a loss. For a 1.6 billion turnover, to effectively break even or make a loss of 1.5 million is you almost think, oh, I might as well just stay in bed. So here, this company is, underlying their claim that they are break even and after adjusted items, a shocking rate loss. So not looking so good at the moment. Let's go look at the balance sheet, see if there's any better news for us in the balance sheet. So here is the balance sheet. So what do we see in the balance sheet? So one of the things that we notice here in the balance sheet, look at the non-current assets. Now, the non-current assets, things that we need to run the business, tables, chairs, plant, machinery, equipment, they've got 1.1 billion. And that 1.1 billion is mainly intangible assets. And those intangible assets is really going to be, we'd expect it to be goodwill. They're kind of, they've grown by buying lots of other business. They'll have some software in there as well, but it'll be mainly goodwill. Again, we can check that by just whizzing off to note 11, just to double check that that is exactly what it is. And so here we have note 11, and it talks about, there's so we got things like goodwill, platform development. So this is their kind of IT, intellectual property. They've got some brands, which is the cost of developing those brands, new product development. So here we are with the kind of the net book value, and you'll see there's the kind of the number, the bottom right hand corner, 674. Let me get my highlighter out. So that's the number that appears in the balance sheet. And most of that is made up of this line here. And if you remember this line here, this column here is goodwill. So this is goodwill on acquisition. This basically is the difference between what you pay for something and the fair value of the net assets. And of course, if you're buying an internet company, you're buying two blokes in mum's attic and their computers. What you're really buying is their brand and their product, their marketing expertise, etc., etc. So that's where goodwill. So that's the intangible as we expected. Let's go back to our balance sheet. So intangible assets. So most of their assets are, basically you can't take it and put it on eBay. It's most of their assets are intangible. They've got some current assets, some inventories, as you'd expect, trade and other receivables, and they got some cash, nearly £1 million in cash in the bank. Nearly £1 billion in cash in the bank. So they've got a pretty decent, and you'll notice that the cash has gone up substantially. So they've done something between 2019 and 2020 to raise that cash. And we think we know what that is, because obviously they went through their IPO, so their flotation. And that's shown to you here in their share premium. We see here a very substantial increase in the share premium, and the ordinary shares. We read these two lines together, in effect showing that's the increase. However, their retained earnings have now gone negative. So they were, what's interesting, they were sitting on positive retained earnings. These guys have been profitable in the past. But 2019 they made a loss, 2020 they made a loss, and are they going to make a loss in 2021? Well, you've got to hang around to find out. Well, certainly from me, unless you want to go and look on the website. So there's their equity, non-current liabilities, borrowings. So you'll notice the borrowings have actually gone down a little bit. Their borrowings, they got some short-term borrowings. They pretty much eliminated, and their long-term borrowings has come down. So you kind of think, well, why are they paying more interest if their debt has come down? Well, the reason is this number here. You'll notice that the right of use assets has increased substantially, while their property, plant and equipment has gone down. So a right of use asset is, rather than buying a photocopier, they're renting the photocopier. That's basically what we're saying. So it's on a kind of some kind of a lease, and so it's a right of use. They get to use the photocopier, but they have to have a finance cost associated with that, and that's really, I think, what's driving that increase in the interest payments in the income statement. And we see that when you see right of use assets there, usually you can find a corresponding liability sitting in the balance sheet, which shows effectively the lease payments they're going to have to make based on those assets, and that's what those numbers are there. And then the last number sitting in our current assets is our trade and other payables, and we kind of expect that. So summary is they've got these right of use assets. That's absolutely fine. Looks like they're making a switch. They're saying rather than buying them, we're going to lease them. That's fine if they want to do that. They got a lot of cash. They're liquid. So if we compare their current assets to their current liabilities, that's just no problems at all. We can't quite do it on the same page, but current liabilities, 564 million, and their current assets are 1.3 billion. So liquidity really not a problem, and their debt has come down. Equity is up because of the flotation money. So they that's really what's driving that. Movement in equity. So we got movement in equity. I think that's over here. Yeah. So the movement in equity, a little bit funny going on here. I couldn't quite work it out. I have to admit, I haven't done my revisited my old accountancy for a while. But what we're quite interested in this column here, this retained earnings. And what you'll see is that you start off with how much profit did you have at the beginning of the year that you've made in the past and having them back to shareholders. And then you show your profit, or in their case, loss. For example, there's obviously this adjustment. This was the error on some kind of a calculation. That was the note 4 we were looking at earlier. And then they've got these share-based payments coming through. So share buybacks. Interesting that they're doing share buybacks. Not 100% sure why that is, but anyway, share buybacks and then some share-based payments. And I'm not sure why they're taking those share-based payments through the retained earnings section in the equity. And again, if we look at 2020, we see here's the loss for the year. Okay, that's what we'd expect. And then suddenly we've got things like the issue of ordinary share capital popping in there as another negative. We got a positive on the share-based payments. And, I have to admit, I did look at note 7. I wasn't really any the wiser. And it just looks like it's a little bit funny going on. So, for me, they've made a loss of, 500 million, yet they're showing a retained loss in the balance sheet of 138. And there's mainly the difference is this share-based payments, whatever's going on there. So if there are any very clever technical accountants watching going, oh Ted, you should know the answer to that, please do enlighten me, because I haven't a clue what it is. That's just me being honest. So moving in equity, okay, fine, let's go to the cash flow. Here's the cash flow. So cash flow from operating activities. Now they are generating cash. Okay, so that is good. They are generating cash, and we can see the cash generated from operations, which is in note 25 here. So it's probably worth going to have a look at note 25 and just see if we can see, why they're making a loss, but they're actually generating cash. Sometimes this is actually contained in the top half, if you remember, of the cash flow statement. Sometimes it's buried in the notes. So here is the cash flow. So what they're doing, they're taking the loss. Okay, so that's the loss from the profit and loss account. They make these adjustments to them. We don't have to worry too much about them. But again, we've got property depreciation, which is added back. That's fine. And then they've got these share-based payments. Now, these share-based payments, I think this is kind of paying people in shares rather than paying people in absolute, in pounds. Would you rather, if you're gonna I don't know, do some consultancy for the Moeed, would you rather be paid in Hut Group shares, or would you rather be paid in the good old Queen's pound note? And well, I know which one I would prefer, I have to admit. But these are share-based payments, and so they don't affect the cash. But I still don't know why they would appear as a positive in the retained earnings. That doesn't seem to make sense to me. A little bit further down, just to clear the annotation, a little bit further down, we can see there's a bit of movement in inventories, etc., etc. So, really what we're seeing here is that, they are generating cash, mainly because they are, I don't know what this adjusted item is, but, it seems to be mainly driven by the fact that they're paying, a lot of their expenses are paid in shares rather than cash. And another reason is there's an increase in trade payables. That's quite a big, substantial increase. That means they're not paying their suppliers. If you don't pay your suppliers, it means you have more cash. So you can show yourself as generating cash. So to me, if you take those two out, and I think it's perfectly reasonable, you can't just carry on not paying your suppliers. At some point, they'll stop supplying you, and then you're in all sorts of doo-doo. So for me, I'm not convinced by that they really are, positive cash flow generating. They've got sustainable cash generating model, not like a telco business, for example, who they take the money in and then they provide the service. They sell those prepaid SIM cards and just generate lots and lots of cash, or people like Facebook, for example. So they are generating cash, and that's good. They are spending money, 351 million. They're buying those subsidiaries. We talked about that. That's where the goodwill is applying. They are buying some property, plant, and equipment, as well as their right of use assets. Total cash used in funding 351 million pounds. And then we've got our financing, and jumping out at us is the issuing of debt. They did issuing of shares. So they've issued a lot of shares. Last year they were refinancing their debt. This year they're definitely in the kind of in the repayment game. So they've used some of that money to pay down some of that debt. They've parked a lot of it. They've used a bit of it to buy other companies. They've parked it, some of it in the bank, and they are hoping to be able to weather the storm, because I'm not convinced that they are going to be cash positive forever. There's my kind of there's the kind of the core analysis. There's nothing I think really I want to add to that. So let's just jump forward. This is the H1, so the sort of the first half, H1. Obviously H2 is the full year, so I don't know why we call it H1, but anyway, it is the H1. So it's the first half. You'll notice here, and this again is on their website, as to how they're performing. So you can kind of basically, as a rule of thumb, just take all these numbers and double them, and you've got the full year forecast type of thing. I mean, it's never quite as simple as that, but there's a kind of a close approximation. So revenue, cost of sales, so revenue still going up. The revenue in 2020 was what, 1.6 billion. If you double that, you're going to be knocking on the door of 2 billion. Cost of sales, gross profit, it's all sort of ticking along. But if you scroll down, and they do put this, I love this, they kind of, here we go, and it's in EBITDA, EBITDA positive. That's the earnings before interest, taxation, depreciation, amortization, which is kind of another way of saying the bits I can control, because I can't control tax, can't control interest, depreciation, amortization. And they give you this lovely little graph down below. And the reason they give you the graph is that they can push the rest of it down onto the next page. So let's go down to the next page and look at below EBITDA. Deduct the depreciation, amortization, and then we come down to, and you will see that they are making an operating loss. So they are still operating at a loss, even if they are forecast to hit 2 billion in sales. They're still making that. It's not a big loss, 17 million, but it's a loss. And quite frankly, we really would like to see, well, as an investor, you'd like to see a profit there. We go back here. We've still got very high distribution costs, administrative costs. They're not being able to deliver. And again, we've got adjusted items, commissioning few facilities. Again, the kind of just way of just like talking about these one-offs, and I get it. COVID is a one-off, but it's amazing how often these one-offs occur on a fairly regular basis. So there we go, Moeed. There's the kind of, there's my analysis of their accounts. Let's go and have a look at their share price and see what was going on with their share price. So here it is. And as you correctly pointed out, it has been tanking. So if you were an early stage investor in the IPO feeling pleased that you'd spotted next year's 20 bagger, you will be crying yourself to sleep each evening. There's no PE ratio, obviously, because there is no E. There's obviously a negative yield. It's valued at 2.25 billion, which is basically twice the balance sheet. So the balance sheet, but the balance sheet is mainly cash because of the IPO. So why would you pay $2 for $1 in cash? That kind of doesn't make sense. This company it's not making a profit. It's not really generating cash as far as I can make out. It looks, I mean, even today it looks expensive. I mean, at flotation it looks crazy expensive, and today, my personal opinion, it's not something I'm falling out of bed to fill my boots with. I like stuff, as you know, which is really, really cheap. And we've come across a few of those in the past. And on my own recommendation, I bought them. And I've probably lost a bit of money on some of them, but we are in for the long term, not the short term, Moeed. So on the long term, on the short term, on the any term, not for me. Thank you very much.
Yeah, well, it seems that some of the investment community would agree with you. So yeah, this was a very interesting one. It was in the papers, you know, later part of November, mid to late part of November. It was all over the place, especially with BlackRock and the fact that its share prices kind of dropped down, and there were some investors that weren't sure. They were wondering, is this too much, or is this because of the a wrong valuation at the beginning, and it was quite frankly too high. So very interesting to see the analysis of their finances, provides a bit more of a perspective and context around that. So you know, if anyone has any comments, if they know a bit more about this company or about the industry, do leave a note in the comment section. We'd love to hear more, and so would our community. So until the next video, thank you, Ted. Thank you, everyone. And we'll see you on the next show.
Good to see you, Moeed. Catch you later.